So we are told here, T Limited, a public limited entity is a holding company in a group of companies. The following transactions relating to deferred tax were extracted for the purposes of finalizing the group financial statements for the year ended 30th April 2022. We have T Limited owns property, plant, and equipment that cost 625 when purchased. Depreciation of 250 million has been charged up to the reporting date of 30th April 2022. The entity has claimed a total capital allowance on property, plant, and equipment of 300 million. On 30th April 2022, the property, plant, and equipment was revalued to 575 million. So we have here our property. So this property, we are only interested in two things. What is its carrying amount? What is its carrying amount? And what is its tax base? And once you give me these two, then straight away, I will be able to give you what we call the temporary difference. The temporary difference. Once you give me those two, I'll be able to give you the temporary difference like that. Now, ladies and gentlemen, please listen and listen to me very well. This property, what are they telling us? T Limited owns property, plant, and equipment that cost 625 million when purchased. Depreciation of 250 million has been charged up to the reporting date. So, ladies and gentlemen, then how do we get our net book value? You see, carrying amount is the same as net book value. Carrying amount is the same as net book value. It will be cost minus accumulated depreciation. All right. So like now the cost, this particular property cost us how much? The cost is 625. And to date, we've been able to subtract there. To date, we've been able to charge depreciation of 250. 250. So can somebody in this particular case give me this value? 625 minus 250 gives me what here? The net book value will be this 625 minus 250, which will give me what value? So somebody is telling me that this should be 375. So this is what I should really bring here. However, later on we shall be seeing what is happening here. So property, plant, and equipment, we have a property whose carrying amount as at the moment before we look at the revaluations is 375. We leave it there. Now, ladies and gentlemen, after that, we continue reading. We are told here the entity has claimed a total capital allowance on this property of 300. So then how do we get tax base? The same. Tax base. Remember the tax accountant and this normal financial, this is a tax accountant, this is a normal accountant here. You guys, they use the same principles. However, when it comes here, now we shall use, so tax base here will be equal to cost minus, in this case here, accumulated capital allowance minus accumulated capital allowance. So the taxman will allow what we call capital allowances, the wear and the tear. All right. This guy is charging depreciation here. So the cost will always be the same. 625 minus capital allowance. Are you able to see the capital allowance? The capital allowance, ladies and gentlemen, we're given there. The capital allowance we're given there is 300. It's 300, not number one. Capital allowance given there is 300. So 625 minus 300, this gives me 300 what here? 325 tax base. 325. So I'm on the verge of straight away thinking about how do I get this temporary difference? But before I do that, there is now a problem. We are told on 30th April 2022, the property, plant, and equipment was revalued to shillings 575. So there is a revaluation. Normally in our books of accounts, what do? We have this particular vehicle. The vehicle here, the net book value is, for example, 370. Just giving an example of a vehicle. And then we come and get a valuer. So this valuer is able to say that, hey, this vehicle is supposed to be worth 400. So in our net book value, in our books, we shall cancel that net book value and write the revalued amount. The revalued amount always takes precedence. So straight away, once I know that there is a revalued amount for this property, there is a revalued amount of 575, I just need to come here by the side. I strike this off and I call this 575 as my new book value, So and once I have this as my new book value, then the temporary difference will be 575 minus 325. So can somebody give me this temporary difference? Can somebody give me this temporary difference? Can somebody give me this temporary difference? 575 minus 325. So this one here, Mike is giving me a figure of 200 what here? 250. But at the back of our mind, we know that there is a working that will have to go to the deferred tax account. All right. There is an asset here that has been revalued, and this is an upward revaluation. So don't forget. Can you kindly give me this revaluation? A revaluation upward. It's a revaluation upward. Remember, this thing was valued at 375 initially. Now it has been revalued to 575 to match. So 575 minus 375. So this gives us what revaluation? And this is you're writing it by the side. You're writing it by the side. So the revalued amount here is 200, and this will affect our deferred tax account. Revalued amounts will always affect our deferred tax account. You'll see how. The devalued amount will always affect our deferred tax account. That's very good. Now, ladies and gentlemen, note number 2, if you allow me, note number 2. On 31st October 2021, the company completed a development project. And they incurred a cost of 200 million, which it capitalized in accordance with International Accounting Standard number 38, intangible assets. So then, ladies and gentlemen, here we have what we are calling some intangible asset. So intangible asset, what have they told us? Which it capitalized in accordance with International Accounting Standards number 38, intangible assets. So they took this as the capital, the cost. All right. The cost. The estimated economic useful life of the intangible asset was 5 years at 31st October 2021. The company obtains full tax relief for research and development expenditure on cash basis. So this will not fit me at all. So the first thing that I need to do is to come here and appreciate that this intangible asset, the intangible asset cost here, the cost is 200. All right. And this cost, ladies and gentlemen, in this case here was incurred when? 31st October. It was incurred on 31st October 21. But you see, we are doing our accounts. If you read the requirement, they want us to compute the relevant temporary differences as at the end of its financial year, which is 30th April 2022. So we're doing our accounts on 30th April 2022. All right. So from the time when we incurred this cost, there's time that has lapsed. So we must charge, in this case here, amortization to be able to get the net book value, because amortization is the language of depreciation, but now for intangible assets, you call it amortization. So come here, and the less in this case here, accumulated amortization. Very easy. They have told us it is 200 straight line, and the economic life is 5. Economic life is 5. So in this case here, we have 200 divided by 5. We have 200 divided by what year? Divided by 5. 200 divided by 5. Great. But now remember, that is per annum for a whole year. That's amortization for a whole year. And yet we've stayed in this case here for how many months here? Look at this. Don't count October. These are the end of October. Don't count October. So we have November, December. And then here we have 4 months because we're going to the end of April. So those are 6 months. So in this case here, the amortization for the 6 months, this will be times 6/12, which will end up giving me how much, ladies and gentlemen? If you're able to remember. Which will end up giving us how much here? So this gives us 20. So 200 minus 20 gives me 180. So this is what we call our carrying amount of this particular asset. So here we have intangible asset of 180. intangible asset of 180. Intangible asset of 180. How about in this case here, the tax base? This is quite easy. Remember, in most cases, intangible asset, the government would always want to incentivize you to do research, to develop things. So the government would want to allow this in full as early as possible. When you indicate like this, you claim the whole of it. Claim when you put tax on it like that, the whole of it. You claim the whole of it. So gentlemen, remember for the tax base, and I'm explaining this for now the very last time, the tax base should always be equal to cost, less in this case here what is allowed. The allowable capital allowance. Allowable, or rather minus just capital, minus capital allowance here. Capital allowance like that. So what have they told us regarding this intangible asset? They've told us the company obtains full tax relief for research and development expense on cash basis. So we incurred a cost of 200. And these guys, because when we incurred this, immediately at the point of incurring this cash basis, the whole of this amount was allowed. So meaning that now moving forward, because we have already claimed this, moving forward, the tax base for this particular asset will be 0. The tax base will be 0. So 180 minus 0 gives me a temporary difference of 180. Because to get temporary difference, don't forget, to get temporary difference, we normally take carrying amount minus the tax base. Anytime they want us to get, the temporary difference, this temporary difference, we take carrying amount minus the tax base, All right, so that's number 2. Unless there is a question, you guys allow me to go to number 3. Number 3. During the year to 30th April 2022, T Limited transferred goods worth 1,500 to one of its subsidiaries. So intra-business, inside business. We should not be making profits from ourselves here. 1/3 of the good, T Limited made a gross profit margin of 20% on its sales. 1/3 of the goods remained unsold by the subsidiary at the reporting date. This is very easy. So we have an item called inventory. Now remember, the tax base, in this case here for inventory, the tax base for inventory will always be equal to the remaining intra-sales. That's how I master it myself. The tax base of this inventory sold in between from group of, or rather a component in the group to another component. So the tax base of inventory will always be equal to the remaining intra-sales. Remaining intra-sales. So remember the total goods that we sold between ourselves here were 1,500. This is the total intra-sale. But by the end of the period, we had already been able to sell some bit of it. What I'm interested in is the amount that remained. And we are told, ladies and gentlemen here, that 1/3 of the goods remained unsold. So 1/3. So times 1/3. So in this case here, the remaining, I hope you have written this in full, the remaining intra-sales will be 500. Is that correct? Is this correct? The remaining intra-sales will be 500, yes. Somebody has confirmed there. So this one, I'm not going to do any alterations. So in this case, the tax base there will be 500. Inventory, whenever there is an intra-group thing, inventory, the tax base will always be equal to the remaining intra-sales. There's no debate about that. But now the accountant here will always have a few issues. The accountant now appreciates the concept of what here, the accountant here, carrying amount. The accountant must consider, the accountant here, in this case here, consider UPS. UPS is unrealized profits on stock. So consider UPS. UPS is unrealized profit on stock. Unrealized profit on stock. That's how you take a small note there. So for carrying amounts, always consider the UPS. And how do we calculate then this UPS? How do we calculate this UPS? To get UPS, we normally take profit margin times remaining intra-sales. So anytime, ladies and gentlemen, they want you to get UPS, unrealized profits on stock. UPS is unrealized profit on stock. You always take the profit margin times the remaining intra-sales. This examiner was gracious enough. The examiner was gracious enough. He gave us profit margin there. He gave us a profit margin there. He gave us a profit margin there. If you look at note 3, he gave us a profit margin of 20%. He gave us a profit margin of 20%. And fortunately, we have the remaining RIS here. We have the remaining intra-sales. The remaining intra-sales is 500. So what is 20% times 500? What is 20% times 500, guys? What is 20% times 500? So it is 100. It is 100. So we know that this is fake value. Fake value. Fake value. Remember, according to IAS 2, there is no way you can ever have profit within stock. According to IAS 2, we should always have inventory valued at the lower of cost or net realizable value. Let us talk of cost. You value inventory at cost. How much does it cost you? Never have profit inside there. So remember, one of these companies in the group are sold to the other. So we have in this case here, this other company that bought, it has goods in stock, and those goods have some profit inside there. So we need to deduct. So whenever it comes to the carrying amount now for this inventory, carrying amount for the inventory, you take the risk given minus now the UPS, because UPS is fake value in stocks, So you take the remaining intra-sales. The remaining intra-sales is 500 minus UPS, which is 100. So 500 minus 100, ladies and gentlemen, that gives me inventory carrying amount of 400. That gives me inventory carrying amount of 400. And then 400 now carrying amount minus tax base. This gives me 100 bob like that. This gives me 100 bob like that. So in inventory, we have very, very important carrying amount in inventory. Remember, the taxman will not allow those things of telling him that you have moved goods from here to another company, that now you would want, in this case, some tax waivers. The taxman is aware of creative accounting. Everybody start telling that, you know what, this sale that we made this sale to one of the subsidiaries. And then you start running away from tax. So the taxman, him, is not interested with any profit, which is what here, any profit in this case here, which is what, which is unrealized. If you charge it, he'll tell you add back. He's not interested with that. All right. He's not interested with that at all. So taxman, his tax base will automatically be the remaining intra-sales. How much is remaining? 500. That's it. But the accountant down there, he has been given a whole standard, which talks about what here? Which talks about 100. Which talks about, in this case here, some UPS. I think there is a question. Sorry. I think there is a question here. Let's first of all address comments here. Please feel free always to ask questions. Feel free always to ask questions. What is negative here? Is it negative? Is it negative? What is negative? 400 is negative. Why negative? Mwikali. Jane is also saying 100. 500 minus 100. Yeah, I should repeat on inventory. Okay. But why are they saying negative? Or 400 minus 500. Yes. Thank you very much. 400 minus 500. Yes. The temporary difference. Yes. 400 minus 500. Yes. Thank you very much. This gives us minus 100. Thank you very much. This gives us minus 100. So allow Mwalimu then to repeat here this inventory. So we look at inventory, two things. We have inventory. So we look at this from the taxman first. The taxman, the tax base how do we get the tax base? To get the tax base, ladies and gentlemen, we shall always look at the remaining intra-sales. So remaining intra-sales. Remaining intra-sales. Very easy. So here we sold goods worth how much between ourselves? 1,500. And by the end of the year, the fraction. Okay, great. So the fraction in this case here, the fraction that was remaining was a third. So the remaining intra-sales, which is our REIS, is 500. It's 500. The remaining intra-sales is 500. This is what you transfer here. The taxman, he takes the remaining intra-sales. Remember, inventory is what is left. Otherwise, the component of units we sold to the subsidiary, which we were able to sell, they book that as sales. We're only interested in what was left behind, inventory, not sold and sold. So it's a third. And then you come, in this case here, to inventory, we come to the carrying amount. How do we get this carrying amount? To get carrying amount, we shall take the remaining intra-sales minus what we call unrealized profit on what year? On stock. Unrealized profits on stock. Please write this in full. Unrealized profits on stock. This UPS is unrealized profit on stock. Unrealized profit on what year? On stock. And how do we calculate this UPS? It's very easy. You take the profit margin times remaining intra-sales. Times remaining intra-sales. So profit margin has been provided this question. The profit margin, we are told there in note 3, that profit margin is 20%. The profit margin is 20%. So profit margin is 20% and remaining intra-sales is 500. So 20% of 500, this is how we were able to pick that 100 bob. And then our REIS here is 500 minus, in this case here, 100. So 500 minus 100, that's how we were able to get 400 mic, like that. That's how we were able to get that 400. I hope, Mike, now this makes some sense and you'll be able to follow it up. Okay. However, your examiner will always tempt you. Instead of him giving you profit margin, I've always seen this, he rarely gives profit margin. What he will do, this ninja, he will come here and tell you that profit markup is 20, profit markup is 20%. So when they tell you that the profit markup is 20%, and I know that to get UPS, I need profit margin, what shall I do? If my profit markup is 20%. If my profit markup is 20%. Profit margin, what do I do? Thank you very much, Paul. Paul ameniambia kitu mzuri sana. If this is A and this is B, to get profit markup, or rather to get profit margin, you will simply take here A over A plus B, like that. A plus B. Thank you so much. So in this case here, margin, hapa base yake ni kubwa. Base yake ni kubwa. So in this case, ladies and gentlemen, A is in 20, tabaki 20 over A, which is 20 plus B, which is 100, which gives me 20 over 100 and what here? 20, which gives me 1 over 6 if you wish. You don't have to cancel, but if you wish, cancel, which gives me 1 over 6. Aya, nisikizeni hapa kidogo, sijui kama hapa ni sawa, naweza vuta sasa hii, naweza vuta hii sasa. I wish you would take this somewhere there as a note. Very important note. Because what will happen, ladies and gentlemen, is this. You will get a situation where, you know, we are saying here that our UPS, or rather, our UPS, yes, our UPS is profit margin, not profit markup times risk. But now you go to a question where you get somebody tells you that profit, instead of giving you profit margin, he gives you profit markup. He tells you profit markup is 1/7. Is 1/7. So you know if it's 1/7, then at the end of the day, you will have to come here and give us profit margin. Iko mwingine alikuwa akiniambia tunajua mwalimu ati profit margin ati iko na makalio kubwa. Makalio, yani hii ndio denominator hii. So unaongeza, ukisikia margin from markup, unaongeza hii. Kwa hivyo sasa itakuja ikuwe 1/7 plus 1. To get margin, you always increase the denominator with the numerator like that, which then gives us 1/what here? 1/8. 1/8. So if, for example, they gave us another small exercise here, they told us that markup, they told us here that markup is 2/9. 2/9. 2/9. Can somebody go ahead and give me the margin? If they gave me markup as 2/9, so margin will be 2/11 years. It can't be 2/10 because you see it's A, B. Here down here we have A plus B, so this A. So I don't know whether it's everybody who is able to see what Mike is giving me. It's only Mike who has responded. So margin, are they able to see this? Because you see this is A, this is A, and this is B. And our formula for margin, itakuwa ni A/A plus B like that. So itakuwa A itabaki vile 2 over this A plus now this B of 9 like that, which gives me 2/what here? 2/11, which gives me 2/11. Please don't get confused with this. This is very popular in your exams. This is very popular in your exams. And then Deborah is asking, why did you divide up there this intangible asset value with 5? You know, amortization is the same as depreciation. Only that now amortization is for intangible assets, and then depreciation is for these other ones that are tangible, the ones that you can touch, so that you can see. So, and how do we get this amortization? Just like depreciation, straight line. We take cost over useful life. So 5 is the useful life there, Deborah. Maybe you could sum up. Economic useful life of the intangible asset in note number 2 is 5 years. And then once you get now depreciation per annum, don't forget to prorate, because that will be 200/5 is 40 for a whole year. And yet we stayed with this asset for only 6 months. So we must prorate. So Deborah, go and look at that deeply. Go and look at that deeply, like that. All right. Ladies and gentlemen, from there, we should be able to move with speed and go straight away to the next item. The next item is called trade receivables. Trade receivables here. Trade receivables. So for trade receivables, what do we have here for trade receivables? Yeah, great. So for trade receivables, we are told trade receivables were carried in the consolidated statement of financial position at 480. Carrying amount is 480. Carrying amount is 480. Carrying amount is 480. Carrying amount is 480. It's 480. This was after an allowance for doubtful debts of 60 million. The examiner will not the examiner, but KRA will not allow that. Not unless there are specific doubtful debts. So this gentleman had charged. This gentleman had charged 60 doubtful debt. I'm going to add back. So 480 plus 60. Add back. So the trade receivables were carried in the consolidated statement of financial position at 480. This was after an allowance for doubtful debts of 60 and an unrealized foreign exchange gain of 80. The allowance for doubtful debts and the foreign exchange gains, losses, are only allowed for tax purposes when realized. So of course they weren't realized. When this gentleman made, this accountant, when he foresaw a gain of 80, of course he must have included it here. And now that this gain is unrealized, you will come and tell the taxman, no, I can't pay tax on what has not been realized. All right. So in this case here, minus what here? You know, when it's a gain, he must have added. So to undo that addition, we subtract. Like when he made a loss, to arrive at this, when he made this doubtful allowance loss, he subtracted. But in this case here, because again it's unrealized, what do? We add back. But gains here, they're added. So gains we subtract. So somebody is giving me 460 here. Somebody is giving me 460. Somebody is giving me 460. So 480 minus 460, this gives us a temporary difference of 20. Temporary difference of 20. Temporary difference of 20. So that is trade receivables. Trade receivables. So kindly repeat on the foreign exchange gain. You know, like any accountant, when you have a gain, what do? When you asset gains, you add. But now after adding, you come and realize that, this is unrealized. It is still outstanding there. You haven't, for example, sold your currency. So you haven't realized it. Will you pay tax on it? No. So what do we do with this unrealized exchange gain? From the taxman's perspective, that has to be subtracted. That has to be subtracted. I hope, Richard, that makes sense. You see, like when you have in this case here carrying amount, when you charge a loss on carrying amount, it means you are subtracted. So to make good, what do? You add back the loss. If in this case here you had a gain in this carrying amount, so a gain means that the carrying amount went up, and you told that this gain is unrealized. So how do you make good? You subtract. You subtract. So if I were you, just always know that losses, when I'm making a good, correcting, losses I'll always add. Exchange gains or whichever gain, if it's unrealized, I shall always subtract. I shall always subtract. Great. Now we go there. Now we are told here that the balance of the deferred tax liability, so that can't come here. Income tax, we are through. We are through. So come and add here. Come and add here the total temporary difference. So the total temporary difference, what do we have here? Total temporary difference. Great. Total temporary difference gives us what figure? Somebody here. 350. Total temporary difference will always give birth to what we call deferred tax. So come here and give us the deferred tax. Come here and give us the deferred tax, 30% times 350, which will end up giving us what figure? 30% times 350, which will end up giving us what figure? It's 105, isn't it? It's 105. And remember, this is an liability. Because I told you, whenever the temporary difference is positive, that's like a profit. So you'll have to share this with the taxman. But now in the future, you'll have to share this with the taxman in the future. So these are deferred tax liability. Deferred tax liability. If it was negative, I would have called it a deferred tax what year? Asset. Now, ladies and gentlemen, from there come here and do Roman 2. Roman 2, they want us to do the account. If you look at Roman 2 of this question, they want us to do a deferred tax account, a DTA, deferred tax account. That's how we call this. So we have what has been brought down there, balance brought down. This is given in note number 6, note number 5 actually. The balance on the deferred tax liability account at the beginning of the year was 25 million. So balance brought down is 25. And what we are deferring into the future, the deferred tax is this 105. So into the future, the balance carried down. The balance carried down is this 105. This is what is deferred to the future. Will not be paid in this year. Deferred, 105. So you ask yourself, remember we have a revaluation amount in this. So this revaluation amount, ladies and gentlemen, leads to what we call permanent differences. Because the revaluation amount here, the taxman will never allow. Remember we said permanent differences are those differences which arise on transactions that are disallowed by the taxman. The taxman will never allow them. And if we never allow them, then they will never feature in our OTR, in our temporary differences. They should never feature there. But now here we have it. And because we have it, then this amount here is overstated. Is overstated. This only happens whenever you have revaluations. So this amount is overstated. So what I need to do is to come here and bring in the revaluation tax. You guys had given me this revaluation amount. It was 200, but I want the tax of it, the tax of that, which is 30%. Revaluation tax. Revaluation tax. So 30% of this 200, which will end up giving me what figure, somebody here? 60, not 6, 60. So go ahead and balance this thing. 105 is bigger. 105 is bigger. 105 is bigger. So the balance is what we'll pay to our income as our income tax expense. Deferred tax and income tax expense. Then, of course, we'll combine it with the annual normal tax expense for you to get the consolidated tax. So the P&L will be 105 minus 60 minus 25. Great. 200, 200, 200, 200, 200. So, of course, in this case, ladies and gentlemen, if this a good student is asking, what would have happened if this was, for example, like a negative here? All right. Then our balance carried down would have come on, you know, if it's an asset, remember assets, what do we do with assets? Balance brought down normally comes here. Balance carried down goes here. So then if it was to be an asset, we do it the opposite. So balance carried down would have been here. Balance carried down would have been on this side. Quite funny, but it happens. You'll also be able to get these kind of things in your exams, where balance carried down is coming. You have a liability, but at the end of the day here, you have, in this case here, an asset. So you simply balance your accounts even if it's coming there and get your stuff like that. Repeat is not 200, but 20. Mwikali, where did you get 20? The P and the L is 20, not 200. How could I get, in this case here, 200 and get this 105? Great. Thank you so much, Mwikali. Great. Should be 20. Should be 2. If there is a ninja who was sleeping like myself, please change. There could be a ninja who was sleeping like myself. So this P and the L is the income tax, the annual income tax. The annual income tax. The annual income tax. Annual income tax. Like that. All right, ladies and gentlemen. So that is it. So there is one assignment that each student is doing. Are you able to remind these other students the assignment? This time around, we are doing, all of us must do assignments, or we come up with a way of what if it was taken as an asset? Are you talking about this 105 if it was negative? The 350, if 350 was taken, if 350 was an asset? If it is a deferred tax asset? Mikali, are you talking about the 350 being negative? Yes, no problem. I've just said here, if it's negative, you'll simply come and put, you know, straight out that this is an asset. You know, normally when it is a normal situation, when you have, in this case here, your assets, any asset, remember asset from double entries, when you have an asset like motor vehicle, you normally bring down here, balance brought down here, balance carried down here. Now, when it's a liability, you do the opposite, like what you've done here, balance brought down here, like that. So assuming that this amount was to be negative, no problem. So I know that negative temporary differences will lead to what we call a deferred tax asset. So deferred tax asset balance carried down will be here. I didn't assume that totally. It will be here. You'd have come and put it here. So balance carried down. In this case, here, the balance carried down would have been here, 105, like that. And then now you'll come and do your balancing as usual. Looks funny to have balance brought down and balance carried down on the same side, but there is no problem. You simply come and balance this. So the P&L will not come here. So you'll come and give me, in this case here, the total here, which will be this 130, so 190, 190. And then now you have the entire P&L here as an income. The P&L will go in as an income. repeat on the deferred tax inputs in the T table. Okay, great. In the T table. In this T table, what do we have here? In this T account, I hope he's talking about the T accounts. T account. So T account. So in the T account, ladies and gentlemen, remember, like now here we have a deferred tax account. So of course you must bring the balance brought down, which is given in note 5. Note 5. So note 5, what do we have there in note 5? Balance on the deferred tax liability is 25. Is 25. And then of course we have balance carried down. So the balance carried down is what you got here as the deferred tax. This is what is going to the other side, 30% of that. This 30% of this 350, this is what gave us 105. If there is any revaluation, like here we had a revaluation, remember we had a revaluation here, which you calculated here. So revaluation comes here. Revaluation comes here, but it's revaluation tax bit of it. So it was 200 times what here, 30%, which gave us what here, 60. So come and do your balancing. I hope that is helpful and you have the video. And I can imagine, Usama, perhaps you were not there in our yesterday's class. Ensure that you guys are able to attend all class. Like the Sunday class is poorly attended. Where do you normally disappear to on Sundays at 2 p.m.? This is not Usama alone, but most of you. Where do you normally go to on Sunday afternoon? Sunday afternoon. Where do you normally go to on Sunday afternoon? Majukumu ni mengi. Great. Great. So please purpose. It's only 3 days a week. Please purpose to be there. Purpose to be there because some of these small topics can easily give us problems in the future. Once you do, you watch like we have done, I think 3 questions here, plus now your assignment question, you will be sorted out big time. You'll be sorted out. Yeah, we have a class from 2 to 4 p.m. You're not supposed to miss that class. What I normally advise my students, if it's church, ensure that you go the early morning church. Attend the early morning church. Not unless. Oh, then there is a confusion there. No, mother, we have 3 classes, remember. 3 classes, Monday morning, Tuesday morning, and then we have Sunday morning, a Sunday afternoon, 2 to 4. Not unless you guys would want us to make a change and bring that class early morning. Early morning. But we prefer also having this 2 to 4 because once the syllabus, of course, there will reach a time when the syllabus will be a bit hot, we can always change. Doreen is saying yes. Early morning we have AFM. So like which early morning day would you want us to have? Wednesday? Wednesday? Wednesday is AFM. Wow, okay. We shall overcome. We shall overcome. So mother, remember, it is Monday morning, Tuesday morning, Sunday, 2 to 4. Sunday, 2 to 4. Hesbon, Thursday. Is Thursday okay? Is Thursday okay? It seems in this case here, there must be pastors here. Thursday, we have AFM. How about Friday? I don't think we can change a timetable in between. It will really bring issues. It will bring issues. It will bring issues. To avoid many issues, people will say we paid having looked at the timetable. To avoid those many issues, Friday morning they have a LM. You can see even things coming there in capital letters. Tuacha namna hiyo. Tuacha namna hiyo. All right. Saturday morning. Hiyo kuna class ingine, I think LM or something. Kuna class ingine. Italeta shida. Hatuwezi. Italeta shida. Wewe, wacheni hiyo siasa nyinyi. Wacheni hiyo siasa nyinyi. We shall overcome. Wacheni hiyo siasa. Siasa ya timetable ni siasa kali sana. Na mkitaka kuipiga, muipige kwa WhatsApp group, mimi siko through the class rep, mniambie. Mpige sasa kwa WhatsApp or wherever, through the class rep, mniambie. Otherwise, I'm happy to serve you. I'm available. The good thing is that I'm quite free. I'm quite free. And somebody taught me something that for you to become rich, a multi-billionaire, you must be willing to serve, happily serve. Kwenye mnapoenda kazi kama leo, always be happy to serve. You will go places. You will go places that you have never seen before. Just a moment. There is something very important that I want here. Okay, so mention there IAS 19. IAS 19. IAS 19. IAS 19. IAS 19. IAS 19. So IAS 19, I will put this link somewhere there. It's a very important link. Doesn't look very organized. I'm not getting one that is very organized, but I like using this for IAS 19. Paste there. I hope somebody will be able to take that link. It can really help you guys. Very good in terms of simplifying IAS 19. So IAS 19 talks about what we call employment benefits. Employment benefits. We are employees. As employees, of course, we expect benefits. We have short-term benefits, our day-to-day benefits, salary, pale na pale. But at the end of the day, we expect long-term benefits in form of what we call pension. Pension. Now, ladies and gentlemen, I would want to take this opportunity here to introduce what we call defined benefit schemes. Defined benefit schemes. When your pension is defined, what happens? And I want to imagine that you guys have written there that this is what we call IAS 19, employee benefits. Employee benefits. Now, ladies and gentlemen, we are told here, there is a small introduction that I would want to run away from. Defined benefit scheme is a post-employment benefit, that creates a constructive obligation to the enterprise's employees. The statement of financial position shows the pension fund as it stands at the year end in terms of the present value of the obligation less fair value of assets. Doesn't it make sense? No problem. So we are saying something very important. Ladies and gentlemen, listen and listen to me very well. Whenever we talk of a defined benefit scheme, this will become your best, and it's very common in your exams. You see, we have what we call defined contribution schemes. Defined contribution schemes. Defined contribution schemes, and then we have defined benefit schemes. Defined benefit schemes. Now, most employers today, what they will do, they will remit to the pension scheme, private pension scheme. They will give you like 6% of your salary. If you're getting 100,000, I know most of you right now, this is where you are, but you'll overcome. I know most of you bado mko iko mwenye hapa amekuwa finance manager. Iko amekuwa finance manager hapa, senior accountant, ama bado mko accountant. Most of you I saw from this retreat that we had on Saturday. Most of you are still very young. Most of you are still very, very young. Very, very young. Young with a bright future, of course. Young with a bright future, of course. Young with a bright future, of course. All right. So I'm assuming this could be your range here, like 100,000. So in this case here, employer, on your behalf, on your gross, so the employer remits 6,000 to some registered pension scheme. And then the employee, if you are good, you match. Always employee should match. So 6,000. So then every month, the guys here will be remitting 12,000 as your contribution to the scheme, to the pension scheme every month, 12,000. They could be taking this to Britam, ICA Lions, depending on your employer. You know, your employer will have a scheme for these employees. Now, ladies and gentlemen, please listen. So you're making contributions. That scheme is not governed by your company. That's a private entity. These guys will take this money and invest. When they're investing, of course, you know, there is what we call pata potea. Hii pesa sio lazima irudi, inaweza pata losses. When these employees are retiring, they may not even have anything. It has happened before. Right? Of course, the companies that we have currently, insurance companies that are using this model, they try their best to invest. And we've never had a situation where they are making really huge losses to the extent that the employee goes home with nothing. But if there is a possibility, it's a risk. They're risking. If that particular company, even if it's being governed by government, if it goes under, the employee for sure will get something very, very small. So that's what we call a defined contribution. You as the employer, your obligation is to make just contributions. What will happen to this employee upon retirement? Upon retirement, these employees will not come to you as to the company. Upon retirement, of kuzana na NSSF, of kuzana na private pension schemes. My role was to basically make the contributions. So that's what we call defined contributions. But those old companies, very old companies, when they used to be really nice, like railways, they used to have post-employment benefits that were very good. Then they used to do what we call a defined benefit. They would say, for example, when this person retires, we would want him to be known that he was an employee of KQ. So we would want him to go home with 20 million. We want him to go home with 20 million. All right. So in this case here, they were defining a benefit up front. They were defining a benefit up front. Right now, I think it is only, if I'm not wrong, the only institution that can guarantee some benefit currently is KDF, Kenya Defense Forces. They'll be able to tell you that when you work for us this number of years, they take up some formula there with your last payslip like that, and then they give you like 3 million. Then they are able to kind of guarantee. But most of these organizations outside here, the only thing they guarantee are the contributions they send to NSSF. After you retire, you'll get an old man pacing up and about in the NSSF offices there. He doesn't go back to the employer. All right? NSSF na msumbua mwingine anakufa jameni, hajapata pension yake bado. All right? Do we have anybody here who could be working for any company that has a defined benefit, where a benefit is defined at employment, how much you'll get? Do we have any student here who is working for a company that is defining a benefit? Oh, great, great. You can see now ACK Provident Fund by the company. Like for example, Central Bank of Kenya, they even have their CBK pension towers. So then they are able to guarantee them that if you work for us for say 30 years, you'll be getting this and there will be some income to sustain you. Lab Trust, DB scheme. Great. Great. Then you guys are not very young. I think this early morning, no wonder they don't want classes late in the afternoon. These guys must be doing very well. These guys must be senior employees at their workplace. They must be senior employees at their workplace. Ladies and gentlemen, please, at this juncture, I would want to take this opportunity to remind you that it's important for you to take care of what your life after retirement. Very important. As I teach you this topic, I always tell my students, please, it doesn't matter. Right now, I'm so sure I've never seen you guys. Leah, I've never seen you. 𝑺𝒑𝒆𝒏𝒕𝒔, I would want to see you very soon. No. Bernard is asking whether this is a new topic. Remember, topic number 1 is about these standards. Topic number 1, we are finishing one standard like that. We shall be able to go to IFRS 13. Topic number 1 is about assets and liabilities, the IFRS specifically. So it's not, you can't call it a new, maybe we call it a subtopic. All right. So whether you like it or not, Daniel and I have never seen you guys, but I'm so sure that if you are in your mid-20s, you guys, as you walk straight, like this, straight. You can even put on your high-heeled shoes, very high-heeled shoes, really, and you walk majestically straight. Trust you me. Once in this case here, you hit like 60, 65, you'll start walking like now this. And that is why, if today you happen to even pass via CBK pension towers near KRA, you will see they have a very good structure there, very good structure, which has a very strong base like this. In this case here, this building, there are twin towers, and these twin towers, they are leaning like this, they are bending. Whether you like it or not, ladies and gentlemen, ensure that you are able to build a good base so that during this life of yours, when you are bending like this, when you can't walk straight, you will have, in this case, something to fall back to. I've always been talking to so many retirees outside here through my consultancies, etc. Retirees wanaumia sana. So in fact, kwanza kama uko private practice, hauna ile formal employment, always be very, you can joke about many things, but don't joke about your pension. Don't joke about your medical. Have a cover. Don't joke about your pension. Have something there. Unakuta mzee alikuwa wapi, amefanya kazi 30 years, akija. I would want you to wonder, also try to look at the inspiration of the architects who drew this structure for CBK pension. You can see these are twin towers. Of course, this is an old man, this is an old lady. You can see now here they are facing the other side. All right. When you start hitting like this, 70 years like that, I mean, mama atashikwa na watoto namna hii, watoto wakifaulu zaidi. I don't know why watoto wakifaulu zaidi, including just gentlemen. Mkifaulu zaidi, ati mna attribute success yenu to mama yenu. Mnawacha mzee. Kama nilikuwa nikiongea na wazee wa not CBK but Stanchart through these talks, they normally give us some work there. Wazee wengi wanaumia. Mama alibebwa akaenda US. At that time, yeye ndo mzee akona ka blood pressure, akona nini, anataka achungwe. Hakuna mtu wa kumchunga. Watu wakitaka kupatia ule mzee pesa, wanapatia mama pesa, mama mgawi. Hawa mama wanagawia kweli wazee pesa. So, especially all of us, ladies and gentlemen, it doesn't matter whether you are a lady or a man. I'm telling you, there is anything that you should really take care of is your pension. Because the moment you hit here, opportunistic diseases, you want Panadol. Ukienda kuomba kijana Panadol, kijana anakuambia pana, wewe ukufanya so and so. It is so. We should always take care of what here. Oh, Daniel, no. I'm telling you, it is both parents. Never be cheated. Both parents sacrifice a lot. sacrifice a lot. It's only that both parents, what I normally do, if I'm giving my mother this money, I give my father the same amount. I always strive. Babaka kupigia simu alikuwa anakunywa pombe tunimjinga, hapana. He played a role. Trust you me. Msiwache wazazi hivyo. Msiache mzee. Wazee wengi wa mama walifaulu zaidi, wazee wengi wamebaki hiki tu hii. Whenever I pass by there, I'm able to see so many things. Unaangalia the other way. So lazima uangalie hiyo pension yako. Hapana, weka mahali ni karibu utakuwa unafikia unachukua. Hapana, pension yako weka mahali utachukua. Yeah, it's both of them. Never be cheated, both of them. And please, the ladies who are around, never. I mean, you'll get a situation where you have done a lot of these things, so najua sana. Utapata saa zingine mama, unaweza kaa na kijana wako ama msichana wako, unaongea mzee vibaya. Unasema mzee hatakuwa anawalipia fees. Hakuwa anafanya so and so. So unasue wa drop and hapana. Ule mzee play role yake. Kama mimi saa hizi vile naamka masaa, wazee wangapi hii ni role, I'm playing a role. Regardless of how bad I could be, I'm playing some role towards, in this case here, the entire family being what you're being. Okay. So wazee wasiwachwe, baraka ya mzee ni ya maana sana. Mjenge, asante sana Paul. Mjenge kitu. Mjenge kitu. There is a place I went, wajabu wakasema, wazee tunajiumiza sana sababu unapata wewe hata kuenda kulipa fees, unapatia mama fees analipa. Mzee ajaenda shule ya mtoto namna hiyo. So ikifika ile time unapata sasa unaambiwa hapa, you may be rich whenever you are old, but you see when you are old you still want companionship ya watoto wako, ya bibi, but we shall overcome. Lakini msiache wazazi. Msiache, mama ni maana, baba ni maana. Now, before I start looking at this, ladies and gentlemen, I would want us to appreciate a few things here. You have a link to this. I would want us to appreciate a few things here. Now, we have what we call, if it's a defined benefit, then defined benefits, we must bring in an actuary. Defined benefits, we must bring in an actuary for what we call actuarial valuations. Otherwise, you will reach that time when these guys are retiring, you'll not be having enough funds to give them. So if you are having, in this case, those companies these guys mentioned, if you look around, they have actuaries full-time, or they hire actuaries to come and do evaluations. They look at, for example, inflation, etc., add this, do this. Actual gains or losses, these occur due to differences between previous estimates and what actually occurred. Normally, the actuaries come at the end of the year, and they'll be able to look at the actual happening versus what was predicted. Past service cost, this is a change in the pension plan resulting in a higher pension obligation for employee service in prior periods. These guys worked for us. It has reached a time, in this case here, these people are being beaten so roughly by inflation. So you have to adjust something for them. They were earning 18,000 per month, like these old teachers. Add them even 3,000. So when you change this pension plan, this is a change in the pension plan resulting in a higher pension obligation for employee service in prior periods. Current service cost. Let me skip this. Current service cost. When these guys are serving us, of course, ladies and gentlemen, we expect in this case here to be making things. We expect to, so increase in pension liability due to the benefits earned by employee service in the period. These guys are serving us today. As they serve us today, if we have a defined benefit, as you shall be seeing, if we have a defined benefit, then at the end of the day, their obligation is growing with us. So when they are working for us this year, when you look at them, you're giving them salary, you must always, as an employer, be thinking about what will happen. There is, in this case, a ballooning cost here. Now, ladies and gentlemen, if I keep on defining these terms this way, you will not understand them. Normally, what I do questions first, and then we go back to these definitions for them to make sense. And this is the question that I would want us to do. I want us to look at April 2022, question number 3B. 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 April 2022. Question number 3B. Question number 3B. April 2022. Question number 3B. Question number 3B. Question number 3B. Once you guys get this question, I would want to finish it before the class ends. Once you get the question, put your thumbs up. And please, you have to open that ACCA book where it's talking about employee benefits, IS-19. Once I do this question, those definitions will make sense from that book. Lots of sense. Lots of sense. Lots of sense. So please open it up and then you put like this as you do that. Parents wote wawili wako na baraka kwetu. Wote wawili. Hata kama mzee alikuwa anakunywa namna gani. Basi kudanganya, kuna baraka yako bado. Hata mama kama alikuwa namna gani, kuna baraka yako bado. Wamepata sasa. So tunaambiwa the following accounting information was extracted from the financial records of KIBO Limited regarding defined retirement benefit scheme. You can see there, it's a retirement benefit scheme. It's a defined benefit scheme. So you can see the net defined benefit obligation. We have net defined benefit obligation as of that date. We have the current service cost. We have the contributions to the scheme. We have benefits paid by the trustees. The market yield on a high quality corporate bond is at the rate of 5%. That yield is the rate of interest. Of course, these monies are invested. Assume there are no tax implications regarding the retirement benefit obligation required with suitable calculations. Explain the accounting treatment of the various elements of the benefits of the defined benefit scheme on the financial statements of KIBO Limited. This is normally very easy. What do we do? Ladies and gentlemen, this is what we do. We normally take the net obligation brought forward, like that. This net obligation brought forward, you assume it's a loan which has been given to you. So you add interest. You add net interest. Net interest on this obligation. On this obligation, you add like that. You add like that. And then, ladies and gentlemen, remember, you must come and add any service cost. Service cost will always be added. When we talk of service cost, we are looking at the past stroke what year current service cost. You add. So as a company, when you make contributions to the scheme, the contributions to the scheme will always reduce the obligation. So you less, in this case here, contribute, you less contributions. You less contributions, in this case here, made to the scheme, you less like that, you less like that. So once you less that, ladies and gentlemen, there is nothing else that you expect apart from what we call expected. So we have here expected, net obligation, expected, net obligation, carried forward, like that. So it is this that you shall be able to compare. You compare this with the actual net obligation, the actual net obligation carried forward for you to be able to give us what we call the remeasurement component. Remeasurement component. What the old standard used to call actuarial gain or loss. Here. Remember, any benefits that you pay to employees, will never feature anywhere here. Benefits paid to employees, I'll be able to explain this, but benefits paid to employees doesn't feature here at all. So please let me know once you are able to write this makosokoso XXX. Once you finish writing, put your thumbs up like this. Get to find swali very fast using this format. Great. So then the question goes like this, very easy. So you can see here, they have given us net benefit obligation at the beginning of the year. That is what is brought forward. If I were you, I would write just there, brought forward. And then we have net benefit obligation at the end of the year, carried forward. This one is actual. carried forward, the actual. So they have given us this is given, this is given. So we start right away. Then we have the net obligation brought forward. How much do we have there? 1850. This amount must earn interest. So you can just mention there, add interest or net interest. Because you see net, why do we call this net? As we're going to see in our next class, which will be tomorrow, we will always have what we call plan asset and the plan obligations. So when you talk of net obligation, already when we subtract the plan assets, when we subtract the plan assets, listen to me very well, ladies and gentlemen. Whenever we talk of net interest, it's because of what here, of course, we're going to earn interest from our assets and pay interest because of what your liabilities. So add net interest. So this, they have given us the percentage. So 5% of this 1850. 5% of the 1850. So this will give me what figure? This will give me what figure, ladies and gentlemen? This will give me what figure, ladies and gentlemen? This will give me, it's only my quiz giving me answers here today. 9250, right? 92.5, I mean. So 92.5. Alafu najiuliza, hawa wafanyikazi wametufanyia kazi. Because wakifanya kazi, tuna expect their contributions to go up. Wakifanya kazi, tuna expect in this case here their pension to go up. So it will be a liability on us. Wamefanya kazi. So unaangalia pale, wametupatia service cost. Kuna service cost. Kuna current service cost. So again, we add current service cost. So current service cost ni ngapi? Current service cost ni ngapi? 200. So are there any contributions that we made to this company? So come and less, in this case here, contributions. Less contributions. So the contributions made to the scheme were 225. And that is it. Leave out the benefits which are there. And I'll be able to tell you why do we leave them out tomorrow. So leave them out. So come and give me the expected obligation. Give me the expected obligation. Give me the expected closing obligation. Closing net obligation. Use the word net always. Expected closing net obligation. Or net obligation carried forward. So you take 1850 plus 92.5 plus 200 minus 225. So somebody is giving me 1917.5. 1917.5. Thank you very much. And what is the actual? What is the actual closing net obligation? What is the actual? What is the actual closing net obligation? What is the actual? The actual, the one that we ticked there. We ticked it there. It's given there. At 31st December 2021, it is 2,000. 2,000. So is there any difference? Yes. So we have in this case here an actuarial. By the way, will this be a loss or a gain? From what you're able to understand to the farm, to our farm, this difference, is it going to be a loss or a gain? A loss or a gain? Uongo, Paul. Paul umedanganya for the very first time. Umedanganya. The loss. Why? Because, this is an obligation. Whenever obligations, in this case here, increase, then we call them what here? Losses. We call them losses. If it's an asset which has increased value, that's a gain. But an obligation, a liability in increasing value, that is a loss to the company. So it's a loss of what here? Mike pia umedanganya kidogo. Ukisema tu jina loss, actuarial loss, useme minus. Usema at KQ may make loss of negative 10 billion. Ukisema tu jina loss. So it's a loss of 82.5. It's a loss of 82.5. It's a loss of 82.5. Great. So this is what we call the remeasurement component. Remeasurement component. The new standard decided to call it remeasurement component. Because the actuarial, this spelling is not right. Actuarial loss. This actually will come at the end of the year. So you look at the expected vis-a-vis the actual. Then it gives you the fair picture. So like now when you're making losses like this, the actuary will demand that, hey, for you to be able to pay these guys their defined benefit, for you to be able to pay these guys their defined benefit after 30 years when they retire, you have to make good. You must bring this loss to the company. So bring the loss to the company. Keep on topping up. You keep on topping up like that. So that when they retire, you should be able to pay what year? The benefit. So please clarify. No. Doreen, we are comparing this. Now we are far away from this. We are far away from this. It could have been much lower, but because of these others, it can go up. What we are comparing is this. You see here, this is what we expected. 1917.5 is what we expected. But now we are getting a bigger liability. You're getting a bigger liability. So when the liability increases, you're losing. You're losing. Just like, for example, these guys who had loans, like Kenya itself, it had loans which are dollar denominated. When in this case here, we were losing value, our exchange, our currency was losing value. I mean, the loan became bigger and bigger. So when the loan increases, automatically you lose. You lose. No, Alan, we can't put it in brackets. We can't. Because you see, when a company makes a loss, when a company in this case here makes a loss, you don't say it has made a loss of -2. You just leave it like this. Not unless, I know what Alan could be talking about. If you're doing like plan assets and plan obligations, kando, that's when we put those brackets and negatives, which I'll be able to show you tomorrow. So for today, it has been quite another question. Great, no question there. So it has been quite a nice morning. We have learned quite a lot, and we have agreed from now today moving forward, students will not be missing classes. When you miss classes, you miss a few things under there. Otherwise, thank you very much. Have a lovely day and put in your best at your workplaces. Bye. Bye.